Hey, accounting scholars, we're at the last section for chapter 11, and we're going to close it out with defining what an annuity is. So, definitional wise, an annuity is a series of equal cash payments made at equal intervals. So an example of this, and your parents might have done this in saving for their retirement or saving for your college education. They might have gone to their employer and said, please every month, please deduct $200 or $300 from my paycheck and put it in a college account for my son or daughter. And they would do this every month. It would be a series of equal cash payments that they would, that would actually be pulled out of their paycheck and put in an investment account. And the question would be, at any given point in time, how much value would that particular account have if, again, invested at a certain rate of return over a given period? So the approach here is very similar to what we were doing with the present and future values. So, we have the same question here. What is the future value of an annuity? If I started investing $200 or $300 each month, what would the future value of that be? So essentially, the annuity calculation answers the question, what is a series of payments going to be worth at some time in the future? In this particular example, we're going to talk about you're actually going to invest $100 every month for 10 years. You're going to earn 12% interest, and the question would be, if I do that, how much money will I have in 10 years? And so the calculations, the ANN here, or annuity amount, is $100. Present value is 0. You're going to do that, the rate of return or rate of interest is going to be 12%. You're going to have 12 periods here, and therefore 12, you're going to be investing over a month each month. That equals 12 periods times 10 years is 120. So your answer here is going to be, surprisingly, if you were to do this, and that's why these types of investment accounts tend to be very lucrative, is you would actually have $23,003.87 after 10 years if you invested $100 every month. And that certainly is doable for most people. How do we get that? Well, the math is pretty straightforward. You take the annuity amount here, which is $100. You insert that insert the other variables into the equation. You do the math, and you end up with $23,003.87. Pretty straightforward. Now, on the other hand, you might want to ask the question, how much might be received today to generate a series of equal payments in the future? So what would be a question that we would want to apply this particular logic to? Okay, we want to buy a car for $25,000. The dealer will finance us at a 10% loan, or a loan with a 10% annual interest rate for 5 years. What are our monthly payments going to be? This is a pretty common question, right? Pretty common question. If you were to buy a car, this would be something that you would want to be able to calculate on your own. So here again, you would your present value. You're going to be buying the car for $25,000 today. The future value is doesn't apply. Your rate of interest is 10%. You're looking for monthly payments, so that's the 12th, and therefore you're going to be doing this over 60 months. So 5 times 12 equals 60. All right. So what's the answer here? Well, surprisingly, it tends to be a number that you might not expect. You're going to be paying something in the area of $531.18 per month. So if you were to buy a $25,000 car and you would use dealer financing at a 10% interest rate over 5 years, your monthly payment, or your annuity payment, right? Your fixed monthly payment over that 5-year period would be $531.18. And here again, the formula is relatively straightforward. You insert the variables into the formula, and you get your $513.18. So that's pretty straightforward. So those are the two concepts we want to investigate in this particular chapter. So we are at the end of chapter 11, guys, and good job. And we will see you tomorrow, and probably we'll go over some of these concepts one more time, and then we will take our test. Have a good night.